Stop. Before you take another breakout trade, answer me one question. How many times have you watched price explode through resistance, jumped in because you were afraid of missing out, only to see it reverse seconds later? You've probably blamed bad luck, market makers, or manipulation. But what if I told you the problem isn't the breakout, it's the way you're trading it? Today, I'm going to show you why most breakout traders lose money and the simple shift that can completely change how you attack these moves. Breakout trading is one of the most exciting strategies in the markets. It promises explosive momentum, fast profits, and the chance to catch the beginning of a major trend. That's exactly why so many traders are drawn to it. Yet despite its popularity, breakout trading is also one of the fastest ways to drain a trading account when approached the wrong way. The biggest misconception is that every price level deserves to be traded the moment it's broken. In reality, the market knows exactly where the crowd is watching. It knows where breakout buyers place their orders, where stop losses are clustered, and where emotions take over. Professional traders don't simply react to price crossing a line, they evaluate context, volume, liquidity, volatility, and whether the breakout is actually attracting institutional participation. In today's video, we're going to expose the most common breakout mistakes that keep traders stuck in a cycle of false entries and frustrating losses. More importantly, you'll learn the practical adjustments that experienced traders use to filter weak breakouts, avoid fake moves, and position themselves for higher probability trades. By the end of this session, you'll never look at a breakout candle the same way again. One of the biggest misconceptions in trading is believing that every breakout is the beginning of a powerful trend. Many traders are taught to buy the moment price moves above resistance or sell the instant it breaks below support. On paper, it sounds simple. If price escapes a well-defined range, it should continue moving in that direction. Unfortunately, the market rarely rewards traders who think in such straightforward terms. In reality, a large percentage of breakouts fail, and understanding why this happens is one of the most valuable lessons any trader can learn. The first reason breakouts fail is because markets constantly search for liquidity. Large institutions cannot enter or exit massive positions with a single click like retail traders. They need enough buyers and sellers on the other side of their trades. Well-known support and resistance levels naturally attract thousands of pending orders from retail participants. When price reaches these areas, it often pushes just beyond them, triggering breakout entries and activating stop-loss orders from traders holding positions in the opposite direction. This creates a surge of liquidity that larger market participants can use to execute their own trades. Once that liquidity has been collected, price frequently reverses, leaving breakout traders trapped. Another reason false breakouts occur is emotional trading. Fear of missing out causes many traders to jump into a trade the instant they see a candle breaking through a key level. They worry that if they hesitate, they'll miss the entire move. This emotional decision-making often leads to entering at the worst possible price right before the market pauses or reverses. Successful traders understand that opportunities are endless, but capital is limited. They know patience is more valuable than speed. Low trading volume is another warning sign. A genuine breakout usually attracts strong participation from market participants, resulting in increased trading activity. When price breaks a level on weak volume, it suggests there isn't enough conviction behind the move. Without sufficient buying or selling pressure, the breakout lacks momentum and becomes much more vulnerable to failure. This is why experienced traders rarely judge a breakout by price alone. Market conditions also play a major role. During sideways or range-bound markets, breakouts tend to fail more frequently because there is no strong trend supporting continued movement. Price simply oscillates between buyers and sellers, creating repeated false signals. On the other hand, breakouts that align with a strong existing trend generally have a higher probability of success because momentum is already working in that direction. Timing matters just as much. Not every breakout occurring during quiet trading hours carries the same significance as one happening during periods of high market participation. When more traders and institutions are active, breakouts often have greater follow-through because there is enough volume to sustain the move. During slower periods, price can drift beyond important levels with little commitment before returning back into its previous range. Another common mistake is assuming that a single candle closing beyond support or resistance confirms a breakout. Markets are dynamic, and one candle alone rarely tells the full story. Many false breakouts begin with a convincing candle that quickly attracts traders before the following candles erase the entire move. Experienced traders focus on how price behaves after the breakout rather than reacting immediately to the first sign of movement. It's also important to remember that support and resistance are not razor-thin lines. They are better viewed as zones where buyers and sellers compete for control. Price often moves slightly beyond these zones before revealing its true direction. Traders who treat every small move outside a level as a confirmed breakout frequently find themselves caught in unnecessary losses. Understanding false breakouts changes the way you view the market. Instead of seeing every break of a level as an opportunity, you begin asking better questions. Is there enough momentum? Is participation increasing? Does the broader market support this move? Has price shown genuine acceptance beyond the level, or is it simply grabbing liquidity? These questions encourage disciplined decision-making rather than impulsive reactions. The goal isn't to predict every breakout correctly because no trader can do that consistently. The goal is to recognize that failed breakouts are a normal part of market behavior and to avoid becoming one of the traders who repeatedly gets trapped by them. Once you stop chasing every breakout and start waiting for stronger evidence that the market truly intends to continue, your trade selection improves, your confidence grows, and your consistency begins to reflect the patience and discipline that separate experienced traders from the crowd. One of the most expensive habits a trader can develop is entering a trade the instant price breaks above resistance or below support. It feels logical because the market appears to be making a decisive move and nobody wants to miss what could become a strong trend. However, acting too quickly often leads to buying at the highest price or selling at the lowest price just before the market reverses. This is why experienced traders place far greater importance on confirmation than on the breakout itself. Confirmation simply means waiting for additional evidence that the market genuinely intends to continue moving in the breakout direction. Instead of assuming that one candle tells the entire story, disciplined traders allow the market to prove itself. This small adjustment in mindset can dramatically improve the quality of trades because it filters out many of the false breakouts that trap impatient participants. Imagine price has been trading below a well-defined resistance level for several hours. Suddenly, one large bullish candle closes above that level. Many traders rush into long positions immediately, convinced they have caught the beginning of a new uptrend. But experienced traders know that a single candle is not enough to confirm strength. They watch what happens next. Does the following candle continue higher with confidence? Does price remain above the resistance level instead of falling back below it? Is buying pressure still visible, or has momentum already started to fade? These observations provide valuable clues about whether the breakout has genuine strength behind it. Waiting for confirmation also helps remove emotion from the trading process. Fear of missing out is one of the biggest reasons traders enter poor-quality breakouts. They believe that if they don't act immediately, the opportunity will disappear forever. In reality, strong trends usually provide multiple opportunities to participate. Missing the first few points of a move is often far less costly than entering a false breakout that quickly turns into a losing trade. Successful traders understand that preserving capital is more important than catching every market move. Another benefit of confirmation is that it allows traders to observe how other market participants react. Markets are driven by collective decisions, not individual opinions. If buyers continue stepping in after the breakout, it suggests confidence is increasing. If sellers quickly regain control and force price back below the breakout level, it signals weakness. Waiting gives traders access to information that simply isn't available during the initial breakout candle. Confirmation can come in several forms. Sometimes it is a strong candle closing well beyond the breakout level, showing that buyers or sellers maintained control throughout the session. Other times it appears as several consecutive candles holding above resistance or below support, proving that the market accepts the new price area. In many cases, price breaks out, pulls back to test the previous level, and then resumes its move. This behavior often provides a higher probability entry because it demonstrates that the old resistance has become new support, or vice versa. Patience is one of the defining characteristics of consistently profitable traders. Beginners often believe success comes from acting quickly, while experienced traders understand that success comes from acting selectively. Every trade should have a clear reason for entry beyond the excitement of seeing price move. Confirmation forces traders to slow down, analyze the situation, and make decisions based on evidence rather than impulse. It's also important to remember that not every confirmed breakout will become a winning trade. Markets are uncertain, and losses are part of the business. The purpose of waiting for confirmation is not to eliminate losses completely, but to improve the probability of entering trades where the odds are more favorable. Over hundreds of trades, this higher level of selectivity can make a significant difference in overall performance. Waiting for confirmation also improves confidence. Traders who constantly chase breakouts often experience frustration because they never know whether they entered too early or too late. By following a consistent confirmation process, every trade is based on predefined rules instead of emotions. This consistency reduces hesitation, minimizes impulsive decisions, and makes it easier to evaluate results objectively. In the end, the market rewards discipline more than speed. There will always be another breakout, another trend, and another opportunity. The traders who survive and grow their accounts are usually the ones willing to let the market reveal its intentions before committing their capital. Instead of asking, "How fast can I enter this breakout?" ask, "What evidence tells me this breakout is likely to succeed?" That single shift in thinking can transform the way you approach breakout trading and help you avoid many of the costly mistakes that prevent traders from achieving consistent results. Many traders make the mistake of focusing only on price when evaluating a breakout. They see a candle move above resistance or below support and assume that the breakout is automatically valid. While price is certainly the most important element of any chart, it does not tell the complete story by itself. To determine whether a breakout has a higher probability of succeeding, you must also understand what is happening behind the move. This is where volume and overall market context become extremely valuable. Volume measures the amount of trading activity taking place during a specific period. It reflects how many buyers and sellers are actively participating in the market. When a breakout occurs with noticeably higher volume than normal, it often suggests that more traders and institutions are supporting the move. Increased participation means stronger conviction, making it more likely that the breakout will continue instead of fading away. On the other hand, if price barely breaks through a key level while volume remains weak, it raises an important question: who is actually driving the move? Without strong participation, there may not be enough momentum to sustain higher or lower prices. Think of volume as the fuel behind price movement. A car with an empty fuel tank may roll downhill for a short distance, but it cannot travel very far without power. In the same way, a breakout with low volume may move briefly beyond support or resistance, but it often lacks the strength needed to continue. This is why experienced traders pay close attention to whether trading activity increases as price leaves an important level. Volume also helps reveal the intentions of larger market participants. Institutions, hedge funds, and professional traders often trade in sizes that significantly influence the market. Their activity usually creates noticeable increases in trading volume. While retail traders cannot see individual institutional orders, they can observe the footprint left behind through volume. A breakout supported by unusually high activity is often a sign that larger participants are involved, adding credibility to the move. However, volume alone should never be treated as a guarantee. A sudden spike in trading activity does not automatically mean a breakout will succeed. Sometimes volume increases because traders are aggressively taking profits or closing existing positions rather than opening new ones. This is why volume should always be analyzed alongside the broader market context instead of being viewed in isolation. Market context refers to the overall environment in which the breakout occurs. A breakout does not exist on its own. It is influenced by the prevailing trend, recent price action, volatility, and the balance between buyers and sellers. For example, a breakout that occurs in the direction of a strong existing trend generally has a higher chance of success than one attempting to reverse that trend. If an asset has been making higher highs and higher lows for weeks, a breakout above resistance is supported by the broader market structure. In contrast, a breakout against a powerful trend often faces stronger resistance because many traders continue to favor the dominant direction. The quality of the price level itself also matters. A breakout from a level that has been tested multiple times usually attracts more attention than one formed over a short period. The more significant the level, the more meaningful the breakout becomes when accompanied by convincing volume. At the same time, traders should evaluate whether price has been building pressure beneath resistance or above support through a series of tightening ranges. This kind of price behavior often indicates that momentum is gradually increasing before the breakout occurs. Volatility is another important part of market context. During periods of extremely low volatility, breakouts may struggle because the market lacks energy. Conversely, during highly volatile conditions, price can move rapidly in both directions, increasing the likelihood of false breakouts and sudden reversals. Understanding the current volatility environment helps traders adjust their expectations and manage risk more effectively. Time of day can also influence the reliability of a breakout. Markets often experience their highest levels of activity during major trading sessions when institutional participation is greatest. Breakouts occurring during these active periods are generally more reliable because there is enough liquidity to support sustained movement. Breakouts during quiet hours may appear convincing at first, but often fail due to limited participation. Successful traders combine all these factors instead of relying on a single signal. They ask whether volume supports the move, whether the breakout aligns with the prevailing trend, whether volatility is favorable, and whether the surrounding price action confirms strength. This comprehensive approach helps them avoid chasing weak breakouts based solely on price crossing a line. The market rarely rewards decisions based on one piece of information. Every breakout tells a story, and volume and market context provide the missing chapters that price alone cannot reveal. By learning to read these additional clues, traders become more selective, improve the quality of their entries, and reduce the number of unnecessary trades. Over time, this disciplined approach can make the difference between consistently falling into breakout traps and confidently identifying opportunities with a stronger probability of success. One of the most effective ways to improve breakout trading is to stop chasing the initial move and start looking for what happens after it. This is the idea behind the break-and-retest strategy, a method that allows traders to enter with more confidence and often with better risk-to-reward ratios. Instead of buying the moment price breaks above resistance or selling the instant it falls below support, this approach waits for the market to prove that the breakout is genuine before committing capital. When price breaks through a significant level, it rarely moves in a perfectly straight line. Markets naturally fluctuate as buyers and sellers react to new prices. After an initial breakout, it is common for price to return toward the level it has just crossed. This pullback is known as the retest. If the breakout is real, the previous resistance often begins acting as new support in an uptrend, while previous support can become new resistance in a downtrend. This change in behavior is a strong sign that market participants have accepted the new price area. The retest serves an important purpose. It tests whether buyers or sellers are truly committed. Imagine price breaks above resistance and immediately rallies. Many traders rush in during the excitement, pushing the market higher. Eventually, some traders begin taking profits, while others who miss the move wait for a better entry. This combination often causes price to drift back toward the breakout level. If buyers step in again and prevent price from falling below that level, it shows demand remains strong. That confirmation provides a more reliable opportunity than entering during the emotional surge of the initial breakout. Waiting for a retest also helps traders avoid many false breakouts. A fake breakout often cannot hold above resistance or below support. Instead, price quickly slips back into the previous trading range, trapping those who entered too early. By allowing the market to complete a retest first, traders can identify whether the breakout level is actually being defended. If it fails, they simply avoid the trade, preserving both capital and confidence. Another major advantage of the break-and-retest strategy is improved risk management. Entering closer to the breakout level usually means the stop loss can be placed at a more logical and tighter location. A smaller stop distance reduces the amount of money at risk on each trade while maintaining the potential for attractive profits if the trend continues. Chasing price after a large breakout candle often forces traders to use wider stop losses because the market has already moved significantly away from the original level. Patience is essential when using this strategy. Not every breakout will offer a perfect retest. Sometimes the market continues moving without looking back. While it may feel frustrating to miss those trades, disciplined traders understand that consistency is built on following a proven process rather than reacting emotionally. There will always be another opportunity. Entering only when the setup matches your rules is far more valuable than forcing trades out of fear of missing out. It is also important to observe how price behaves during the retest. A healthy retest often occurs with slower, less aggressive movement than the initial breakout. If price returns to the level in a controlled manner and buyers or sellers quickly regain control, it suggests the trend remains intact. On the other hand, if the retest is accompanied by strong momentum against the breakout direction, unusually high selling or buying pressure, or repeated failures to hold the level, it may indicate that the breakout is losing strength. Candlestick behavior during the retest can provide additional confidence. Rejection candles, strong closes in the breakout direction, or several candles showing that the level is being defended can all strengthen the case for a trade. Rather than focusing on a single candle, successful traders evaluate the overall story the market is telling. They want to see evidence that the breakout has shifted the balance between buyers and sellers. The break and retest strategy also encourages emotional discipline. Instead of feeling pressured to react instantly, traders learn to let the market come to them. This shift in mindset reduces impulsive decisions and creates a calmer, more structured trading routine. Over time, waiting for confirmation becomes a habit, making it easier to avoid low-quality trades driven by excitement or fear. No strategy guarantees success on every trade, and even the best break-and-retest setups can fail. Markets remain unpredictable, and losses are part of trading. However, by waiting for the breakout to prove itself, entering after the market confirms the new level, and managing risk carefully, traders place themselves in situations where the probabilities are more favorable. Consistently applying this approach can lead to better entries, smaller losses, improved confidence, and a more disciplined trading process that focuses on quality rather than quantity. Even the strongest breakout setup can become a losing trade if risk is managed poorly. Many traders spend countless hours searching for the perfect entry signal while giving very little attention to how much they risk, where they place their stop loss, or when they plan to take profits. In reality, long-term success depends far more on disciplined risk management than on finding flawless trade setups. A trader who consistently controls losses can survive periods of poor performance, while someone who ignores risk can erase weeks or months of gains in just a few bad trades. The first principle is deciding how much of your trading capital to risk on a single position. Every trade carries uncertainty, no matter how convincing it appears. There is always a possibility that the market will move against you. Because of this, experienced traders never commit a large portion of their account to one idea. Instead, they keep the amount at risk small enough that a single loss has little impact on their overall capital. This allows them to continue trading objectively without feeling pressured to recover from a devastating setback. Position size should always be determined by the distance between your entry price and your stop loss, not by how confident you feel about the trade. Confidence can be misleading because markets often behave differently than expected. A trader who increases position size simply because a setup looks perfect exposes themselves to unnecessary danger. By keeping position sizing consistent and based on predefined rules, emotions play a much smaller role in decision-making. A stop loss is one of the most important tools a trader has. It defines the point where the original trade idea is no longer valid. Many beginners make the mistake of placing stop losses too close to the entry, causing normal market fluctuations to trigger them before the trade has a chance to develop. Others place stops so far away that one losing trade causes unnecessary damage to their account. A good stop loss should be based on market structure rather than on an arbitrary number of points or percentages. It should be placed beyond a level that, if reached, clearly suggests the breakout has failed. Equally important is resisting the temptation to move a stop loss farther away after entering the trade. This is often driven by hope rather than logic. When traders refuse to accept a small loss, they sometimes allow it to grow into a much larger one. Successful traders understand that taking controlled losses is simply part of the business. Protecting capital is always more important than proving a trade idea correct. Profit targets deserve just as much planning as entries and stop losses. Entering a trade without knowing where you intend to exit often leads to emotional decisions. Some traders take profits too early because they fear giving back gains, while others hold winning trades for too long and watch profits disappear during reversals. Having a clear exit plan helps eliminate this uncertainty and creates consistency over time. One useful approach is to evaluate whether the potential reward justifies the amount being risked. If the likely upside is only slightly greater than the possible loss, the trade may not be worth taking. Strong breakout trades often provide opportunities where the potential gain is meaningfully larger than the predefined risk. This balance allows traders to remain profitable over the long run, even if not every trade is a winner. As a trade begins moving in your favor, risk management continues to matter. Some traders choose to reduce risk by adjusting their stop loss once the market has clearly confirmed the breakout. Others may secure part of their profits while allowing the remaining position to continue if the trend remains strong. The exact method may vary, but the objective remains the same: protect capital while giving successful trades room to develop. Risk management also includes knowing when not to trade. If market conditions are unusually volatile, if volume does not support the breakout, or if the setup does not meet your trading plan, choosing to stay out is often the smartest decision. Avoiding poor quality trades is just as valuable as executing good ones. Professional traders understand that preserving capital during uncertain conditions gives them the flexibility to take advantage of better opportunities later. Consistency is built through repetition of sound habits rather than occasional large wins. Traders who focus only on making money often become frustrated by normal losses and start making impulsive decisions. Those who focus on managing risk understand that profits are a byproduct of disciplined execution. They accept that losses are inevitable, but ensure those losses remain controlled and manageable. The goal is not to avoid losing trades altogether, because that is impossible. The goal is to make sure no single trade has the power to significantly damage your account or your confidence. By controlling position size, placing logical stop losses, defining realistic profit targets, and following these rules with discipline every time, traders create a framework that allows them to stay in the game long enough for their edge to play out over hundreds of trades. That consistency, rather than any single winning breakout, is what leads to lasting success. The greatest difference between consistently profitable breakout traders and those who struggle is rarely their charting platform, indicators, or market knowledge. More often, it comes down to mindset. Breakout trading can be emotionally demanding because the market moves quickly. Opportunities appear and disappear within minutes, and false breakouts can test a trader's confidence. Without the right mental approach, even a solid strategy can fall apart under pressure. Developing a disciplined breakout trading mindset is what allows traders to follow their plan consistently, regardless of short-term results. One of the first mental shifts successful traders make is accepting that they do not need to trade every breakout they see. Beginners often feel that every move is an opportunity that must be captured. This creates a constant fear of missing out, leading to rushed entries and poor decisions. Disciplined traders understand that the market will always provide another setup. They are willing to let dozens of mediocre opportunities pass because they know that protecting capital is more important than being involved in every move. Patience is another defining characteristic of successful breakout traders. Waiting for confirmation, monitoring volume, and allowing price to complete a retest can sometimes feel frustrating, especially when the market appears to be moving without you. However, patience is not about doing nothing. It is about waiting until the odds are more favorable before taking action. Every minute spent avoiding a low-quality trade is often more valuable than the excitement of jumping into a questionable one. Discipline also means following a trading plan regardless of emotions. Every trader experiences excitement after a winning streak and disappointment after a series of losses. The problem begins when emotions start changing the rules. After several winning trades, some traders become overconfident and begin increasing position sizes or taking setups that do not meet their usual standards. After losses, they may hesitate to enter valid breakouts or try to recover quickly by taking unnecessary risks. Both reactions are driven by emotion rather than logic. A disciplined trader follows the same process, whether the previous trade was a winner or a loser. Another important mindset is accepting losses as a normal part of trading. Many people enter the markets believing successful traders rarely lose. In reality, even the best traders experience losing trades regularly. The difference is that they do not view losses as personal failures. Instead, they see them as business expenses that come with operating in an uncertain environment. As long as the trade followed the plan and risk was controlled, a loss is simply one outcome in a long series of trades. Confidence should come from your process, not from the outcome of individual trades. Many traders judge themselves based on whether the last trade made or lost money. This creates an emotional roller coaster where confidence rises after wins and disappears after losses. Experienced traders evaluate themselves differently. They ask whether they followed their rules, respected their risk limits, and executed the trade according to their strategy. By measuring success through discipline instead of profits alone, they remain emotionally stable regardless of short-term market fluctuations. Keeping realistic expectations is equally important. Breakout trading is not a strategy that wins every time. False breakouts are a natural part of financial markets, and even well-planned trades will sometimes fail. Expecting perfection only leads to frustration and emotional decision-making. A disciplined trader understands that consistency comes from maintaining a statistical edge over many trades rather than trying to predict every market move correctly. Maintaining a trading journal is another habit that strengthens discipline. Recording the reasons for each trade, the emotional state before entering, the outcome, and lessons learned helps identify recurring patterns. Over time, traders begin noticing whether they perform better when waiting for confirmation, whether they frequently chase breakouts out of fear, or whether certain market conditions produce stronger results. This ongoing review encourages continuous improvement instead of repeating the same mistakes. Emotional control becomes especially important during periods of rapid market movement. Strong breakout candles can create excitement and urgency, making traders feel they must act immediately. A disciplined mindset resists this pressure by relying on predefined rules rather than emotional impulses. Instead of reacting to every price movement, successful traders observe, evaluate, and then decide whether the setup truly meets their criteria. Ultimately, breakout trading is less about predicting the next big move and more about consistently making high-quality decisions. The market cannot be controlled, but your preparation, patience, and discipline can. Traders who develop these qualities avoid many of the costly mistakes caused by fear, greed, and overconfidence. Over hundreds of trades, this steady approach builds confidence, protects capital, and creates the consistency needed for long-term success. In the end, your mindset is not just another part of your trading strategy, it is the foundation that determines whether every other part of your strategy can be executed effectively.